Hello everybody, it's me the Boss Hog, and today I'd like to have a look at the results from Fevertree Drinks PLC, typically just called Fevertree. They were published on the 16th of March. I'd like to walk through them, my interpretation, perception. We're going to walk through this deck that they provided, but don't worry, I've already done the reading, so we're just going to highlight a couple of items. And what I've also done is I've pulled out some of the financials so we can just focus on them instead of going through this. For anyone not familiar with Fevertree, I've got a couple of notes here just to walk through. So this is a soft drinks company specialising in premium mixers for drinks. Now, this is a UK company founded in 2005, and the founder remains the CEO. Now, the mixers were originally for gin, which is a bit of a UK-centric spirit, but ultimately, in about 2018, they reached what's typically called peak gin, and ultimately they saturated the UK market. They are the number one, gin and tonic provider, have been for a number of years now, replacing Schweppes. And what became obvious in 2008 was that they needed to diversify ultimately. And we're currently kind of 3 years into what I would say is a 5-year journey for Fevertree. It has had some growing pains, as we're about to see, and it's a case of, what's their next couple of years look like. Now, currently this is a £2 billion market cap company. It's listed on the FTSE AIM. If it was listed on the FTSE main index instead of the alternative investment market, it would be on the higher side of the FTSE 250. So just for guidance here, this is a, like I say, multi-billion pound company. I would say the share price has been fairly volatile, so it has gone anywhere between a sort of £1.5 and £3 billion market cap over the last sort of couple of years. But that's where we are currently. So trades under the ticker FEVR, FEVR, and it operates in 18 markets, which it groups into 4 regions, and that's UK, Europe, USA, and rest of world. And I'll just add that rest of world is almost entirely driven by Australia and Canada, which account for 80% of that slice. Now, in terms of the revenue from each one of those segments, you're looking at the UK there with 36%, Europe with 28%, USA with 27%, and rest of world with 9%. So it's pretty diversified. Definitely rest of world is a bit of an outlier and a laggard. And really the main growth engines are both Europe and USA, which have both been growing in the mid 30% year on year over the last couple of years. The UK, like I say, it kind of saturated the market in 2018, but over the last couple of years, it has shown a 15% increase in revenue in its UK market as well. So arguably not bad. But again, we'll have a look at the numbers in a bit more detail a little bit later. Now, as is standard on these, I think it's important that we do some disclosures. So I currently have 255 shares of Fevertree. They are one of my, I would say, mid-sized positions. They just about sneak into my top 10. I'm currently on an unrealized position of minus £113. So I have an average here of 1821. And obviously, as you'll see in a second, we're currently in the mid-17s. So down a little bit, but no problem for me. And I have previously owned and sold Fevertree before, buying at £19 and selling at 24. Not a huge position previously, but I just thought I'd put that out there as well. So I'm more or less breaking even on my combined experiences with Fevertree. I want to be clear as well, I have no known connections to the company or anybody working for or with Fevertree that I'm aware of. I've also not been paid to do this video. And also, I mean, it should be said because, I want to make sure I can keep myself honest. I'm unusually evangelical about this product. I was on the hype train for Fevertree many years ago, way before I got into investing, basically when I first discovered it in a pub. I am a gin drinker. Gin and tonic is one of my spirits of choice. And basically, I consider Fevertree completely superior to Schweppes. Since then, it's diversified into other mixers. I'm personally a big fan of the cola. I think it's delicious with whiskey and it really kind of adds to it. Lovely vanilla taste. But in general, I like the products. I like the branding. I think it's awesome, basically, and it is a good product and better than its comparatives on the market. So I think that's worth adding. I guess just so we can keep myself honest and, you understand where I'm coming from. So that's an overview of the company. That's the disclosures. And what we're going to now do is we're going to walk through the deck that they provided. So let's do that now. So I've gone through this and I'm going to start by talking about their what they call off-trade growth. So when COVID struck, basically, it really hit Fevertree very hard. They weren't prepared for it. They had, they were still going through these like logistical changes, trying to scale up and, add other markets into their remit. And the on trade, which is basically through restaurants and pubs, got really hammered, as you can imagine, right? Lots of lockdowns, etc. So what they did is they pivoted into off trade. And for me, this is one of three areas that's important for the success of Fevertree in the future, right? How well does off trade sales hold up as on trade starts to recover? So we've seen some really great results here that they are highlighting it. About a year ago when I last did this video for Fevertree, it was clear that both the market and Fevertree didn't really know what the recovery was going to look like, and how much off-trade sales were going to remain. So even though they've guided for sort of a modest reduction in off-trade growth, or I guess off-trade revenue, they're still expecting the majority of it to remain once on-trade kicks in, which means excellent, that we like that. Also, as well, it's worth highlighting that the off-trade has had an impact on their margins. Even things like logistics has kind of eaten into that as well. So we'll get to the earnings separately, but that's definitely one of the things that's been pressuring the share price over the last year. You can also see here, if we look in the bottom left, right, you can really see the value of the market that it has. Obviously here the US is potentially the biggest opportunity. This is really when they're talking about their total addressable market. So they talk about sort of premium mixers, and we'll see in a second they talk about the premiumization of both spirits and indeed the mixers for those spirits over time. And I think it's relatively compelling, to be honest with you. And by the way, when the results were published this morning, the market really didn't like the results. And for me, that was twofold. The earnings were under pressure and the revenue guidance for next year was weak. But I have to say, between sort of when Fevertree did this at 10 o'clock this morning, you gradually saw the share price like recovering and actually finishing much higher on the day, sort of 10% up on the day. And I think it's because they really take the time to explain why the margins are under pressure and how they're going to be recovering, and what the revenue opportunity and kind of general direction and opportunity looks like. So I was actually quite impressed, because before the earnings call at 10, I was actually really disappointed, specifically with the revenue guidance. Like, I think actually Fevertree here have a lot of runway. US, like I say, is the main one. Even in the UK, 40%, it's not like they completely dominate the market. Yeah, they're a clear number one front runner, but there's still 60% here that we can be targeting. And likewise, you can see here that the other markets as well have a lot of room to grow. So this is all encouraging from my perspective, both in terms of their existing market penetration and the fact that off-trade revenue is holding up relatively well. So that's pleasing. What I also want to touch on as well, just because it has an impact on those margins, is this point I've highlighted here, yellow. So during the last year, or 2 years really, since they've been getting up and running in America, they haven't had a bottling plant and basically a canning plant, they call it, so where they fill the bottles in America. So they've basically been having to ship everything, right? And that, you're seeing huge increases in the cost of transport, as well as the raw materials for making those bottles, right? Glass, steel, that sort of stuff as well, that actually go into making a bottle. So I think this is important to highlight as well. So this is where I think their journey really comes into it, right? They talk about this premiumization and the journey of spirits, basically. So spirits, and gin is a really great example. Gin in the UK used to be called Mother's Ruin, because ultimately it would lead to sort of sons and husbands miserably drinking themselves to an early death, right? Had a terrible reputation. But over time, sort of gin has become quite trendy. And, you're seeing similar, I guess, with things like tequila, vodka arguably as well, rum likewise. So there's lots of opportunities here. And you can kind of see that although maybe the global alcoholic market is kind of under pressure, it's a bit split. Beer is down quite a lot, wine to a little bit, and spirits is actually up. And, I would say here the stuff on the left is pretty modest, like these aren't huge movements, but the stuff on the right here is huge movement, especially what they class as super premium and premium. And you can gradually see that, since 2015, those two used to account for 30% of the market, and now we're more like 45% for 2025. So here you're looking at, a significant increase in the opportunity there. And basically, Fevertree's approach and their slogan is, when 3/4 of the drink is tonic, make sure it's a good one, because, what's the point of spending good money on a premium spirit to not then spend good money on a premium tonic, right? And again, that to me makes a lot of sense. And, assuming that this trend continues, there's clearly an opportunity for Fevertree here. So that to me makes a lot of sense. There's some good stuff in sustainability, if that's your thing. To be honest with you, it's not the reason why I invest in Fevertree, but they are entirely carbon neutral, so that's great. Again, I'm not going to spend too much time here because I think I've made a nice summary that we'll walk through once we've gone through this presentation here. But one of the things to highlight is, so this is gross margin, which has been under pressure for many years. And really here, what I want to highlight is this 3.6%. So you can sort of see, you know, of the fall from 47% to 43%, really here, the vast majority of that is just logistics costs. And you can also see here on the right that much of that's being driven by the US. So Fevertree's argument here is like, yes, our margins are definitely under pressure. However, you know, 80% in their wording was because of these logistic costs, right? These freight costs, etc., etc. And by the way, the fact they have to ship things into America also means that they're much slower to respond to sort of market opportunities and those sort of things as well. So it's a case of, guys, bear with us. You know, we've got a bottling plant coming online. We've got another one at the end of H2. You know, and then they're also looking at having a filling plant in Canada as well. So they're clearly sort of going through that journey at the moment. And they also likewise said that eventually their production capacity is going to be significantly improved. But in the short term, it basically means they're going to have inefficiencies, right? Like those factories aren't going to be up and running fully. There's going to be some niggles to work through, etc., etc. So it was a case of, you know, pain today and jam tomorrow, basically, in a lot of what they were saying, to be honest. Likewise as well, the inflationary headwinds here. So they believe that, you know, their costs are going to increase by about 9%, which is going to have an impact of 450 basis points, very significant for that. And likewise, moving forward here, you're looking at 150 to 200 basis points further. So that would then put their gross profit, you know, basically in the 30%. What they've got here is a bunch of mitigating actions. Like, by all means, feel free to just pause the video and have a look at that. But these mitigations make sense, you know, and assuming that they can deliver them would then start improving their profit margins again. So we'll see how that looks, basically. I don't want to spend too much time here. Obviously, feel free to pause if you want. So in terms of 2022 guidance, this is the bit that originally, and to be honest with you, I remain quite underwhelmed by. The main reason for that is because their 2021 revenue was a 23% increase, which to me is really solid, and it would have been 27% on a constant currency basis. So I was a bit disappointed to sort of see this revenue guidance for the current year just up 15%. Like I wanted to really see a little bit more, and it's also interesting here how it's broken down by area in the growth. So yeah, we'll see how that looks, but I'm a little bit underwhelmed by that revenue growth, to be fair. Like for me, I think if you buy into the idea that, you know, the market is supportive, the general move to premium spirits and mixers is supportive, they're scaling up, right? I want to see revenue growth kind of accelerating at the moment. There's significant room there, and actually 15% is really just matching their saturated market. So I think like the revenue was the main disappointment for me personally. The rest of the market was more focused on earnings, but I was kind of expecting that to be under pressure, and it was sort of in the ballpark that I was expecting personally. So, but again, I think it's worth highlighting both those points because that's really what's pressuring the share price. There are a couple of assumptions that they've made in this. So, you know, on-trade remains open, so basically no further lockdowns here is what they're saying. Off-trade, we've already spoken about, remains strong in our international regions. And I think it's worth highlighting that evidently they've had a solid start to trading in 2022. So that's, again, good to see as well. So I think here the mitigations make sense. I think the cost pressures, again, make sense. They were talking about, you know, what their price points are. Several analysts on the earnings call highlighted, you know, the fact that Fevertree in the States especially is really priced as a super premium product rather than just a premium. You know, was there going to be any move to sort of soften that price point? And the simple answer was not really. You know, they want to maintain that, and they think there's some good opportunities, particularly in the tequila market, which they think has been underserved. So, you know, they're working on that. And likewise as well, the rum market as well. I think, again, with the cola, it's going to be delicious. So there's, oh, and by the way, they also became the #1 ginger beer brand in America over the last year. So I think that's pretty great as well. So this is the guidance for 2022. The margins will have to see whether they can mitigate in the way that they've described. And the revenue here, I think this is a little bit underwhelming, to be honest. I would like to see more revenue. We can play around with some numbers shortly, but that's what they've committed to. So. And then in terms of strategy, so I won't spend too much time here, but you can see, as I just mentioned, the ginger beer, which to me was a good surprise. Likewise, they've already replaced Schweppes in the US as the #1 tonic mixer, which again happened in the UK many years ago. But there's just, broadly speaking, some positive things here. So this is just all good from my perspective. It makes a lot of sense. This is the high level, you know, across the 4 groups that we already discussed. we're just going to zoom through these. So they talk about here on trade rebuilding. So again, as everything starts to open up, the fact that they're growing faster than the market is a consistent theme within this. So, they're basically saying, listen, spirits are growing, and within spirits, premium is growing, and within premium, we're growing faster. So that's it, basically. Like, we have the best product, and we're outperforming a growing market. That was ultimately their sort of their bull case. Ultimately, why you should invest in them. This top right here is a really good example, right? So the value share is the 40% that we saw earlier. So, they're up 13% versus 2019 against other premium brands, which are down 12% since 2019. Now, in fairness, I'm not entirely sure what they're classing as premium brands here. Let's not add a comment. Stop that. There we go. Because that's an incredibly small market, so it's not including Schweppes. So maybe there's an element of being selective here. But again, you can see that despite the challenges over the last couple of years, shall we say, it's still pretty decent growth. So likewise as well, they continue to sort of see off trade, so increasing household penetration here. This is off trade stuff basically. And likewise as well, highlighting that a number of their newer flavors, to be honest with you, they're not my cup of tea, but maybe I'm an old man at heart. But they're starting to see sort of basically an increase in penetration in younger people, which they apparently count as under 45. So I guess I still do count as not an old man just yet. So that's pretty good. So all good here, basically. They're basically saying in the UK, which is their main market, on trade is due to recover, and off trade, remains pretty decent. I don't think there's too much to add here outside of what we've already said. I do want to just touch on the US because, like I say, that's clear from Fevertree's approach that's their main, their real sexy growth. Basically, they had the CEO of the US on the call, one of only a couple of people. So again, that to me was a clear indication of the fact that he has considerable power within the organization. And again, here you can see that the direction is really good. I think the bottom left here is quite telling as well. How do you drink spirits? Again, with a mixer is the way to go. I was actually kind of surprised that cocktail was down as well. And again, I think there might be some selective bias here, that Fevertree is trying to make themselves look as good as possible. Less surprised to see neat and as a shot especially falling. So that to me was interesting as well. And likewise as well, I was actually really encouraged by this partnership with national brands. Like, these are all good brands, right? It makes a lot of sense to me how they're working together. A lot of these brands, both in the US and in other markets, are kind of run by the likes of Diageo, and other large companies as well. So there's always a hope with Fevertree that one of these companies is going to sort of buy Fevertree. I have no news on that front. No one's even suggesting at the moment, but that's the sort of thing when you read analysts or kind of speculators that they hope for that kind of stuff. To be honest with you though, I like the engagement with spirit brands, and it's kind of helping Fevertree build market penetration and always build a market in premium tonics and mixers. So that's really interesting. This sparkling pink grapefruit here was specifically what they called out in terms of a tequila mixer. I have no idea if tequila and grapefruit is a good combination or not, but apparently it's the thing. So that's great. And also here, they've called out a couple of notable accounts. Fevertree really likes to monitor how many Michelin star restaurants it's in, and how many premium hotels it's in and stuff, right? Like that, it likes those metrics. They're on its website. And it was interesting with Wynn, especially, the casino and hotel brand, that they was the last major operator in Las Vegas that they didn't have. So, they were really pleased to get this, basically, to now have basically every major company on the strip has Fevertree as its product. So they were quite happy about that as well. So, but yeah, so this was encouraging for me, and the way that they were positioning in the US is a bit different to other markets. The fact that they're really targeting super premium rather than just inverted commas premium, and they're pricing accordingly. This is all really good. So, the orange bars here are basically the growth of Fevertree's products. And compared to the market. So, ginger beer here. I actually tried the ginger beer this week. I guess you can call it market research, product research. Pretty good. Not necessarily my cup of tea. I did also try it with whiskey, which is what they recommend drinking it with. And I was pleasantly surprised. I thought it would kind of massively overpower it. I'd still rather have the cola, but I guess, if the Americans like ginger beer, they like ginger beer. Likewise as well here, all of these growths are really good. You can see here ×4, ×5. So what we're really seeing here is an acceleration in their outperformance, which is great, right? This is the kind of stuff that I'm talking about. I want to be seeing an acceleration if I'm going to be really optimistic in terms of multiples and, share price for Fevertree. So there's some really good encouraging signs here from America, basically, is my summary of it. Yeah, nothing. I mean, this is just more of the same, basically, in terms of, their outperformance here is kind of running significantly ahead. Great. So in terms of Europe, again, more of the stuff here in terms of the premiumization, to use their wording, and likewise, basically their outperformance within that, right? Whether that's the total, the value, or the other premium, right? It's all basically we are growing faster than any sort of competitor, right? Whether that's the mixers, whether that's the value, whether that's the premium, and even other premium brands are outperforming non-premium, to be clear. But Fevertree is outperforming them, so that's really, again, more of the bull case. And I mean, they've divided their markets here, core, next wave, earlier stages. These are all grouped into Europe, right? So Europe has the most countries, as you'd kind of expect. But so their core is kind of like saturated, more or less. Then you've got the next wave here is they're kind of up and coming, and their early stage. So to me, this was also really good to see. I guess the only thing I would point out is Belgium and Spain had a slight fall. So they didn't really go into the reasons for that, to be honest. And I don't have a breakdown of Europe by countries. But the overall grouping here again showed 35% year-on-year growth, as we'll see very shortly. So moving in the right direction as a whole, certainly. More of the same. Rest of the world, I don't want to spend too much time on. As I've mentioned already, Australia and Canada 80% together, but broadly moving in the right direction, trying to sort of build that market. This is on a much smaller revenue total than the others. So again, I don't want to spend too much time here. More of the same though in terms of the premiumization, and likewise more of the same in terms of Fevertree's overperformance. So. And like supportive customer trends, right? That's really it. It's all moving in a way that should be beneficial to Fevertree. This is kind of their takeaway slide. So feel free to pause this. It's a 32-page deck. And it was actually relatively pleasant listing, I have to say. So again, feel free to go and onto their investor relations website if that's your bag. But ultimately, what they're saying here is, like we've had these challenges. Yeah, we reached peak gin in 2018. We had a difficult COVID, as you'd imagine, but there's a lot of kind of promise. One of the things that they spoke about was looking to rebuild their margins, especially from 2023, and this is how they're going to be doing it. But broadly speaking, it was a kind of revenue growth story. And again, like I might be slightly contrarian here and slightly different to the market. And I don't want to ignore the earnings margins, and we'll spend some time on those in just a second. But ultimately, to me, I view this as a growth stock. It's not a, with the exception of the UK, arguably, the rest of their markets, it's about revenue growth. There'll come a time when they'll have to really work on their margins, and their earnings more generally from a stable base. But right now, Fevertree isn't at that base. This is basically how well they can grow. And in fairness, they were talking about that in several of their markets, they're basically having to create a premium category for mixers. So again, they're sort of like leading the way, and hopefully that will put them in a very strong position, and they'll be able to build on that ultimately. So for me, when I look at Fevertree, there are three things that kind of get me excited about the business and kind of are a bull case. That's the holding up of off-trade sales, seems promising. Their success in going into other mixers, and again, that we're starting to really see that with the colas, with the kind of new products like the grapefruit, with the ginger beer, etc. So that's also encouraging. And then it's international sales, which again is running in the kind of mid 30% for the two areas that really matter, which is America and Europe, right? We can kind of park the UK and rest of the world for now. In terms of the growth of international, it's those two regions that really matter. So that's the exciting bit, because basically all of that performance is looking really good. From a negative perspective, you've got significant pressure on margins and really underwhelming revenue growth targets. So, and if you trust Fevertree, they've got mitigations in place. They're confident that, like these pressures are about to be managed. And, after 2022 and going into 2023 and beyond, they were optimistic that they'll be able to rebuild margins. So that's kind of a credibility exercise, and ultimately for you guys to decide how you feel about it. Now, in terms of me deciding, I want to bring this back to some numbers. So let's go over here. And first of all, we're going to look at a financial overview. So I've just taken these numbers. They're in the deck that we just covered, but I've simplified it, or made, at least for me anyway. So first of all, revenue here. So you can see how this is divided across the three areas. This is on a constant currency basis. So like I say, if you sorry, this isn't on a constant currency basis. If you were to do it on constant currency, it would be 27%, so slightly more encouraging. But yeah, you can see here, like, right, the two areas that matter. Great. I would say as well, the UK being at 15% is pretty solid, and then rest of world, very small market comparatively, but that's where it is currently. So this is a gross profit up 12%, and this is where it starts to get a little bit negative. So gross margin here, dropping from 46 to 41, right? The mitigation or the explanation is that 80% of that's caused by American freight and logistics. Okay, kind of get it. But still, this number has been under pressure now for quite a few years and was in the 50% only 3 years ago. So definitely gone backwards. Likewise as well, even though revenue is growing at 3%, adjusted EBITDA is only up 11%, again, because of those pressure on margins. And here it's even more extreme. Like this was a business that, again, a few years ago was a 30% margin. And now, it's actually in danger of dropping into the teens. Now, this was pretty interesting because, again, several of the analysts really put the CFO on the spot regarding this. Do you think we can get back to 30%? And basically the answer was yes. And you'll see in a second in the numbers, some of the projections. If you take that, then there's a very steep growth curve here in terms of their earning. Obviously, though, if you don't believe that and you think that the earnings are going to continue to be under pressure, then that story looks very different in terms of like planning out to the future. So we'll see. So in terms of EPS, up a little bit, but nothing major. And I thought this was also worth including because basically Fevertree trades on an incredible multiple. In the past, it's been, north of 70. Currently, it's 46.7. And that was based on a closing price of, for the 16th of March, which I have as 17.84. And likewise, last year's closing price was 25.31. So just to kind of give you an idea there of what that looks like. So you could argue that this is looking comparatively cheap on the basis, but hold that thought just for a second, because again we'll have a look over a longer time frame very shortly. Somewhat encouraging, I guess, to start with the kind of mere point, which is that revenue growth continues to be modest, but is getting there. And dividends are kind of likewise. So dividends are up 2%, nothing major. This is the full year dividend specifically, so full and interim. So this is their total dividend for the year. What they did announce, though, was a special dividend, which was a bit of a surprise. It's a modest size. It's about 3% of their share price, just under. And they basically said, we're really confident in the business. We wanted to reward shareholders for a couple of difficult years. However, we're not yet at a stage where we believe we can constantly do this. So we didn't want to make it kind of a significant increase in our ordinary dividend. This is basically a reward for shareholders who have stuck with us for a couple of years. Been through it with us, and what we'd like to do is have a more consistent dividend growth policy for ordinary dividends, but we're going to park that for now because we need some firepower. But here's a reward. So that was kind of well received, to be honest. Again, I wasn't 100% sure how I felt about this, but it feels pretty good, especially if you have been a shareholder for Fevertree. Your share price has been all over the place, so depending on how the market's feeling. And to be fair here, I also thought this was quite interesting in their net cash. So it was a bit of a shame none of the analysts asked about acquisitions or anything like that. What was said is they basically want to be able to respond to market conditions. So I think this is sort of a combination of a safety net and kind of to be able to seize on any opportunities that come. But you can see here their cash position has actually increased quite a lot. And, considering this is a £2 billion company, they have a reasonable amount of cash on hand, basically, to manage anything that comes about. So like I say, I don't have too much to add here other than, these are the numbers. Make of them what you will. And now the really juicy stuff. So in terms of projections, so I've done this out to 2027 because I think 5 years is a reasonable amount of time. And also it was what the CFO mentioned in terms of margin recovery. So what I've done here just to explain this, so obviously everything up until here, these are actuals. And then everything out from here is growth. So I've assumed here a 15.5% revenue growth year on year. I think that's realistic. And if anything, I hope it's pessimistic, but this is kind of what they're committing to, right? This 359.3, like I say, 15.5%, and it's almost bang in the middle of their own range of 355 to 365 for this year. So that felt fine to me. Likewise as well, a bit to here. So this is based on their EBITDA margin. Now this is where it gets a little bit spicy. So I haven't gone all the way back here. I didn't see any point in me going back further than 2020. So here for 2022, I've assumed that it's going to stabilize, right? According to them, they're going to have a challenge of 200 basis points, but actually have opportunities to improve it by 350. So you could say there's like 1.5% upside here, right? Which is then what I've done in 2023. And then likewise, it was a case of, well, do you think we can recover toward 30%? Yes, we can, but it's ultimately going to take us 5 years out from here. So I've basically done that gradual scaling up as Fevertree started to do it, and kind of given them the benefit of the doubt. Obviously here, these are going to materially change the numbers if you think that this is too optimistic. That's fine. Play around with your own numbers, or ask me, and I'll see what we can do. This here, their diluted EPS is based on historic trends, so hopefully here this makes some sense. And then what I've basically done is calculated a forward PE based on, again, the 16th of March closing price. So what it basically looks like right now, if you were to buy shares on and, assume these numbers above are correct, you're basically buying into a business which has a forward PE of 40 at the moment, and obviously here I'd expect it to change, but, it's a 2-year forward PE of 32, 26, 21, etc. Right? But obviously the share price isn't going to stay static across that time, or it might, in which case buy. And then what I've done is I sort of looked at a PE, and I think, to be honest, depending on who you speak to, there are a considerable number of opinions here on what the underlying PE for Fevertree should be. I thought about it and think that 40 is about right. It is growth. It's increasingly got a good moat, a dominant market position in more and more of its market that it operates. It has traded at those levels before. You can see here, when it was really humming in 2018, we have like 50. Then, like this forward PE here gets a little bit ahead of itself because, the share price hasn't quite come down after, peak gen and the challenges with COVID. And ultimately, as EPS slows, you then end up with a bigger multiple. So I think we can kind of discount 2020. Like, I think that is pushing it. Like, to get 70 PE is pretty mental. I think that's just too ambitious. I mean, I've included it here just in case you think that's okay. I could definitely see if somebody wanted to argue with 50. I could see somebody, if you wanted to argue with 30. I think 20 is a bit harsh. A lot of things would have to go wrong to kind of be at that sort of level. But again, this is what it is looking like. And ultimately for me, what I look at here is, like if I'm looking at a 40 PE in the current year, I'm really looking at a share price of 15.28, which, it was actually before the earnings, down in that kind of level, not quite, but approaching it. Obviously it was up 10% today, so fine. But I also thought it was kind of interesting because then if you assume a 40 PE in the current financial year, actually you more or less get bang on the share price as it closed. So again, to me, this is kind of like the market reinforcing my kind of opinion of where the PE should be. And likewise as well, if you plan out a little bit here, then you can start to see what that looks like in terms of share price. Now, in fairness, if you think this company should be trading at a 50 PE, then you should absolutely be buying this right now, right? Because you're basically getting a 20% discount against what it currently is, right? Which, just as a reminder, is 17.84. My opinion on this, I'm not buying at current levels. Like, I think there's a considerable amount of risk here. I was a bit underwhelmed on the revenue, and I think really they have to prove that they're able to mitigate their margin pressures. I think they have a sensible approach to it. Their story was completely credible about, their expansion, the freight costs, etc. I think it was believable. We all understood it. The mitigations make sense. And like I say, that there's a real good opportunity here. I think, like, if you take the bull case, it's very easy to kind of see that, but at the same time, there are still considerable risks. Lockdown would have impact. Any sort of increase in cost is going to be potentially harder to pass through. It's going to have those impacts as well. And in fairness, although in many regions they're creating an addressable market, yeah, okay, but that also then means that eventually you're going to get competitors. This was actually something that got raised about the US specifically, so that was pretty interesting as well, if you believe that is a threat. So for me here, I would absolutely buy under about 16. And I think here, like in the past, when I looked at Fevertree beforehand, I had a pretty broad estimate of where I think the share price should be based on sort of lots of scenarios that the business could do. So I was between 21 and 27. I sold at 24, as I mentioned, which is my midpoint, and was, to be honest with you, was happy enough. I now think that this 2200 here is a much more reasonable target. I basically reduced my target price for Fevertree by 10% and narrowed down the range, to be honest with you. And although I think that there are some significant growth opportunities here, maybe paths to get back to 50, maybe even higher PE, I don't immediately see it tomorrow. And to be honest, I wouldn't be buying shares at this price, assuming that, you agree with a 40 PE, because frankly, I think there are safer, better companies, especially currently, than Fevertree, right? Go and buy Apple for less than 30 PE. Go and buy Microsoft for sort of 35 or whatever it's at. Disney at the moment is going to be on something like a 20 PE, right? Those kind of companies are really where I'd be focusing. I think you don't want a new position in this company. It's my opinion, unless you truly believe, most of the optimism that you're hearing from Fevertree, and or you believe that actually it deserves to trade at a forward PE of 50. And by the way, if you do, then absolutely, you're basically having a share price immediately of 2200, right? So at under 1800, to me, that's a clear buy. But I think that's a bit of a stretch. And I think, for me, the where it's basically at now feels like a fair value to me. That's how I feel about it. So I won't be looking to materially increase my stake at current levels. I think it would need to be under 16 and basically approaching 15.28. Before I really got excited. I probably will reinvest the dividends into Fevertree. It should get me about 5-6 shares, something like that. So that feels pretty good. But otherwise, I don't think I'm going to be adding a ton of more money into Fevertree. But it wasn't a terrible update. There's clearly some good opportunities here. So I won't be selling either. I'm just going to sit on my stake and go from there. So that's my opinion, my overview of Fevertree, the results, and my own opinion as buy, sell, or hold. Hopefully that was useful. Any questions, please let me know in the comment section below. Thank you very much, everyone. I've been the Boss Hog, and good luck with your investing. Bye for now.